Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine this. You're standing at the edge of a vast, dynamic frontier. The American housing market. It's a colossal $13 trillion landscape, a place where the foundational dream of homeownership often collides with the tough realities of fluctuating interest rates and economic shifts.
It's been a real battleground lately, hasn't it? High rates, uncertainty.
Exactly. For a while now, this market has felt like a tightrope walk, with lenders grappling to find their footing as borrowing costs squeezed the life out of refinancing and slowed home purchases to a crawl.
A real squeeze.
But what if one company, a true powerhouse, armed with cutting-edge artificial intelligence, strategic acquisitions, and a deeply focused vision, is not just weathering the storm, but quietly positioning itself for a powerful surge when the economic winds inevitably shift?
That's the narrative around rocket companies, isn't it? The Detroit fintech player.
Precisely. They aren't just surviving. They seem to be strategically engineering a resurgence. That brings us to the core question for you, the individual investor. With these game-changing acquisitions like Redfin and the big Mr. Cooper deal and the growing talk of lower rates,
The whispers are getting louder.
is Rocket Company's stock a coiled spring ready to unleash massive upside? Or is it just another mirage in this volatile market?
That's the multi-billion-dollar question.
So today, we're going to pull back the curtain. We'll look at the leadership, trace its history, unpack the business model, scrutinize the financials, everything. Our goal is to give you a clear path to being incredibly well-informed, building towards a solid perspective on Rocket's potential.
It's definitely a pivotal moment to examine Rocket, especially now when you look at the architects of their ambition. The leadership really stands out.
Yeah.
Smart, adaptable, which you absolutely need in this market.
Let's start at the top. Varun Krishna, CEO since September 23.
Right. His background is impressive. PayPal, Intuit, that screens fintech innovation. He's really the one pushing Rocket's shift to an AI-first strategy.
And that's not just talk, right? They're actually implementing it.
Oh, definitely. Take Rocket Logic's agentic AI. Think of it like a super smart digital assistant that handles complex tasks on its own. It's already automating earnest money deposit reviews.
What does that translate to in real terms?
It's saving them nearly 20,000 hours a year. That's huge. And it dramatically speeds up loan processing, which is critical for winning deals today.
Speed is everything in mortgages.
Absolutely. And his focus isn't just internal. He's revamped the broker portal for Rocket Pro. That cut their outbound outreach by 20% less chasing, more efficiency, and empowered over 1,000 partners with better compensation options. These are real operational gains hitting the bottom line.
And we can't discuss Rocket without Dan Gilbert, the chairman, the founder. His vision basically built the company into what it is.
No question. Gilbert's the visionary. His drive-shaped rocket, you see his strategic hand in massive moves like the $9.4 billion all-stock acquisition of Mr. Cooper.
That deal is enormous.
Yeah. It positions Rocket to service 1 in 6 U.S. mortgages. Think about that scale. Plus, they're projecting $200 million in synergies, cost savings, revenue boost by 2027. It underlines their whole vertical integration play.
It's not just him steering the ship, though.
Not at all. You've got Brian Brown, the CFO, who skillfully managed their liquidity up to $9.1 billion by Q2 2025. That cash provides a vital safety net, especially now.
Crucial in this rate environment.
Then there's Noah Edwards, Chief Revenue Officer. He's been key in boosting their purchase market share by 8% year over year, largely by integrating real estate services smartly.
And the board expertise.
Suzanne Shank, CEO of Siebert Williams Shank & Co., brings that deep capital markets knowledge. She was instrumental in their $4 billion senior notes issuance, which funded these big acquisitions. This whole team is focused on integration and tech. The Redfin deal in July 25. That's about expanding the purchase pipeline, improving conversion, connecting the vision to scalable growth.
That founder connection seems really baked into their DNA. How involved is Dan Gilbert today? Is it more strategy, or does he still have his hands in the day-to-day?
He's deeply involved strategically as chairman. His influence goes right back to 1985, founding Rock Financial. It's not just legacy. His oversight is active, often through his family office, Rock Ventures.
So even though it's public?
It effectively operates as a founder-led company. Gilbert holds a majority stake through Class D shares. That gives him over 70% of the voting power.
Which aligns his interests directly with shareholders, right?
Exactly. His net worth is tied directly to the company's performance. It ensures a long-term perspective. You see it in the push for AI, the big acquisitions like Mr. Cooper, prioritizing compounding value over short-term bumps.
And founder-led companies often do well.
Studies show they often outperform. Rocket's 27% market share in its origination segment is strong evidence. Gilbert's long view drives decisions meant for sustainable growth, which ultimately benefits you if you hold the stock, especially if rates do come down.
That drive clearly shapes their purpose. Let's talk about that, the mission, the vision, the culture that fuels all this.
Their mission is simple and powerful. Help everyone home. It taps right into that core American dream, focusing on accessible homeownership.
And the bigger vision.
It's about restoring faith in that dream, making homeownership truly owned, not rented. They're using fintech to democratize access in this huge $13 trillion housing market.
The Amazon of housing idea comes up a lot.
That's the analogy they use. A vertically integrated platform driven by AI and data, offering a seamless experience from search to closing and beyond. And they have concrete goals tied to it. Krishna mentioned aiming for 10x business volume without adding headcount, purely through AI.
That's ambitious. How does the culture support that?
Through their ISMs, guiding principles like obsessed with finding a better way and we'll figure it out. These foster real innovation among their 15,000 plus employees.
Are these just posters on the wall?
No, they seem lived. AI tools automate routine tasks, freeing people up. They focus on inclusivity. And the external validation is their 22 JD Power Awards for client satisfaction. That culture directly fuels objectives like hitting 8% purchase market share by 2027. It connects the vision to tangible results.
It's fascinating how culture translates to market position. Let's shift gears and trace Rocket's journey. It's a history defined by adaptation, isn't it?
Absolutely. It started small in '85, Rock Financial in Detroit. Gilbert focused on efficiency from day one. But the real pivot was 1999, launching an online platform, rebranding as Quicken Loans. They basically pioneered digital mortgages way back then.
Ahead of the curve.
Definitely. By 2019, they had 9.2% market share. Then came the game changer. Rocket Mortgage in 2015, the first fully digital end-to-end home loan.
Perfect timing for the refi boom.
Incredible timing. During 2020-2021, they originated $351 billion in loans. Revenue shot up 267% year over year to $15.7 billion. It was validation of their digital-first strategy.
But it hasn't all been smooth sailing. The '08 crisis must have hit hard.
It nearly took them down. But Gilbert stepped in personally, $500 million of his own money. And they strategically pivoted to focus on more resilient FHA loans. They rebounded strongly, revenue growing from $1.3 billion in '09 to $5.3 billion by 2013. Shows incredible resilience.
And more recently, with rates climbing.
Another adaptation. Post-2022, they shed non-core assets like their Canadian unit, cut costs by 20%. But crucially, they gained 8% year over year in purchase market share in 2024, while others struggled.
The numbers back up this story of adaptation.
Clearly. From 2019 to 2024, revenue CAGR, that's compound annual growth rate, pronounced CAGR, hit 15%, despite the 2023 dip. Origination market share climbed from 5% to 9.2%, outpacing peers like UWM.
And they're diversifying too, right? With Rocket Money?
Yes, the Truebill acquisition in 2021, now Rocket Money. Adds personal finance tools, diversifies revenue. They're aiming for 20% non-mortgage revenue by 2025. All these moments, the crisis bailouts, the AI saving thousands of hours, have built a company that really does look like a coiled spring, ready if rates fall.
It's a compelling narrative of evolution. So let's get into the mechanics. How does this engine actually work? Unpack the business model for us.
At its heart, it's quite straightforward, especially if you use modern digital services. It's a fintech platform for mortgage origination and servicing, designed for speed and accessibility.
The Uber of mortgages analogy works.
It really does. Apply online, get quick approval, minimal paperwork for closing. Rocket handles the complex back-end funding, payments, all of it.
But the real value is deeper than just the app, right?
Exactly. The nuance is in the interconnected ecosystem and how they make money. Primarily through gain on sale margins. Fees earned when they originate a loan and sell it to investors.
Standard practice.
Yes. But then there's servicing fees. This is increasingly vital. They manage a huge portfolio, $578 billion as of Q2 2025, generating recurring income. Plus, ancillary services like title insurance via Rocket Close.
Okay, let's tackle the more technical bit. MSR's mortgage servicing rights.
Right, MSRs, pronounced MESRs. They're intangible assets on the balance sheet, valued currently around $6.2 billion. Their value moves with interest rates.
How should we think about those?
Think of them like owning the rights to collect subscription payments for a long time. They generate predictable cash flow. But here's the catch. If rates drop significantly, Homeowners refinance. Those subscriptions churn out, reducing the MSR value.
So there's complexity there.
Definitely. While the model is accessible, MSR volatility and regulations, like for FHA loans, add layers. Especially now with big acquisitions like Mr. Cooper boosting servicing scale integration needs to be managed carefully to handle those risks.
That clarifies the core components. So what really makes Rocket's model unique in this crowded market?
It's the unique blend. Digital origination excellence combined with that mission for homeownership, all fueled by massive scale and data. Unlike traditional banks stuck with branches, Rocket is 100% digital.
And that translates to better performance.
It seems so. $29 billion originated in Q2 2025 with a 2.80% gain on sale margin. That's higher than the typical 2.5% for peers. Efficiency matters.
And the vertical integration is key to this uniqueness.
Absolutely. They've built this closed-loop ecosystem, Rocket Homes for listings, Rocket Mortgage for the loan, Rocket Close for title, Rocket Money for budgeting. It's like Apple's hardware-software synergy.
The Redfin acquisition fits right into that.
Perfectly. It brought brokerage in-house. Redfin's 50 million monthly visitors now flow directly into Rocket's mortgage funnel. They're already seeing a 15% lift in conversion rates from that early data. It fuels Gilbert's Amazon of housing narrative, powered by AI like Rocket Logic automating 80% of earnest money reviews, slashing costs.
So in a fragmented market, they stand out.
Massively. Remember, 85% of searches start online, but only 15% originate digitally. Rocket's 97% client retention and 27% purchase origination share show incredible product market fit. It drives an economic engine where fixed costs shrink as volume grows, leading to that $172 million in adjusted EBITDA in Q2.
With this unique setup, how do they actually connect with customers? What's the distribution strategy?
It's a smart hybrid model, direct-to-consumer plus wholesale, but with digital being the defining feature. Direct-to-consumer, or DTC, is dominant 73% of originations. That's through the Rocket Mortgage app and website.
Self-serve, mostly.
Largely. Clients use the app, supported by AI chatbots, even virtual closings. This digital approach cuts their origination costs by about 30% compared to traditional lenders with branches.
And the other 27%.
That's wholesale through Rocket Pro. They partner with independent mortgage brokers. Rocket Pro gives these brokers better tech portals, pipeline visibility, flexible compensation. Over 1,000 partners adopted the new splits in Q2 25.
So it's scalable.
Immensely. DTC handles 65 million annual interactions efficiently. Wholesale taps into existing broker networks for wide reach, without Rocket building more physical infrastructure.
And they integrate offerings across these channels.
Yes, that's where it gets clever. Take Rocket Preferred Pricing, launched after the Redfin deal. It offers 1% rate cuts or $6,000 credits to Redfin buyers. Early signs show it's boosting conversions. It also means less cold outreach needed, faster closings.
Did this model prove itself in the recent tough market?
Absolutely. In 2024's high-rate environment, this hybrid approach grew their purchase share 8% year over year. They originated $92 billion when many peers saw declines. It shows resilience and strong customer stickiness.
Given all these moving parts, originations, servicing, rates, how predictable is Rocket's revenue? Is there a stable base?
There is. It's a deliberate mix of predictable and variable streams. The servicing fees from that huge $578 billion portfolio make up about 30% of revenue. That's highly recurring 97% retention, generating around $410 million quarterly from long-term contracts. Average MSR life is 27 years.
So that provides a cushion.
A substantial one. It buffers against rate cycles. In Q2 2025, for instance, servicing income held steady even as originations dipped a bit.
But the majority is still variable.
Correct, about 70%. That includes the gain on sale revenue, the 2.80% margin on $29 billion volume in Q2. That part is directly tied to refi and purchase volumes, which are very sensitive to rates. Refis dropped 80% after the 2022 hikes, remember.
And the MSRs themselves have that rate sensitivity too.
Exactly. While the contracts offer predictability, prepayments from refinancing when rates fall can erode their value. They saw a $500 million MSR fair value hit in 2023. So while that 30% recurring revenue is stabilizing, enabling that solid Q2 adjusted EBITDA, the cyclical exposure is real. They actively use hedging, like forward sales, to manage that downside risk, especially looking ahead to potential rate cuts.
That makes sense. You need both growth potential and stability. Let's shift to the products themselves. What does Rocket's product powerhouse actually offer day to day?
They offer a really comprehensive suite of fintech products, all centered on homeownership, and the market clearly likes them. 9.2% origination share, 97% retention speaks volumes. The core is Rocket Mortgage, the flagship digital platform.
That originated the $29 billion in Q2.
Right. 73% purchases, 27% refis. Features like Rocket Logic AI automating approvals are key to their speed advantage. And those 22 JD Power #1 rankings aren't trivial. They show consistent user satisfaction in a market where that digital experience gap still exists.
What about new things, recent launches?
Rocket Preferred Pricing is a great example post-Redfin. Offering those 1% rate reductions or 6K credits to Redfin buyers is already lifting conversions by 15%. Their roadmap is heavily focused on expanding AI.
The 10x goal without headcount growth.
Exactly. The Q2 agentic AI for earnest money reviews saved 20,000 hours. Future plans target more broker tools, personalized financing, all through automation.
And tying the ecosystem together.
Huge focus there. Rocket Homes for search, Rocket Close for title, Rocket Money for budgeting, which manages $1.5 billion in subscriptions now. The vision by 2027 is clear. Double purchase share to 8%, refi share to 20%. Leverage Mr. Cooper's servicing for $200 million in synergies. Create that seamless platform from search to lifelong financial management.
That's a big vision. How are these operations managed logistically? Where are they based?
Primarily U.S.-based,
Yeah.
centered at that massive Detroit headquarters campus, 3.3 million square feet. That's the hub for origination, servicing, AI development, supporting 15,000 plus employees. It underscores their digital focus. No physical branches.
But they have other locations.
Yes, key ones. Phoenix for servicing and tech. Cleveland hosts Rocket Homes. Seattle came with the Redfin deal for brokerage, and Dallas will be a major servicing hub once the Mr. Cooper deal closes, expected Q4 2025.
Do they own all these places?
They own the Detroit HQ, but strategically lease other facilities, like in Phoenix. Gives them flexibility, especially with remote work trends. Outsourcing is minimal core tech, like Rocket Logic is built in-house. They might partner for some ancillary things like title processing to scale, but they control about 80% of the supply chain themselves.
So very tight control. Let's talk more about that vertical integration. How deep does it go, and what does it mean for their supply chain strengths and weaknesses?
It's highly integrated. They control almost the entire mortgage lifecycle origination, servicing, now even real estate brokerage. It's deliberate, minimizing dependencies, boosting efficiency.
From start to finish.
Pretty much. Rocket Mortgage originates, Rocket Close handles title, and post Mr. Cooper, they'll service that $1.2 trillion portfolio, 1 in 6 U.S. mortgages. This control drives cost savings, like the AI cutting earnest money processing time by 80%, saving those 20,000 hours annually. It enhances customer experience too, hence the 97% retention versus the industry's 85%.
How does that compare to competitors?
It gives them higher margins. Compare them to someone like LendingTree, which relies heavily on outsourcing. Rocket's 2.80% gain on sale margin versus a typical 2% reflects that integration benefit.
What are the core strengths of this integrated supply chain?
Their proprietary data is huge, 10 petabytes feeding their AI models. And their partnerships, especially the broker network via Rocket Pro.
And the vulnerability.
The main one is the rate sensitivity of those MSRs, that $6.2 billion asset. But again, they actively hedge that risk. Acquisitions like Redfin adding 50 million visitors actually fortify the chain. Overall, it allows them to cut costs, like the 20% year-over-year trim, outpacing competitors with more fragmented models.
This brings us squarely to their competitive advantages, the moat. How does Rocket defend its turf?
Okay, let's break down the different layers of their moat. First, the market structure itself helps. It's an oligopoly. Rocket, 9.2% share, UWM, 7%, Wells Fargo, 5%, control about 40% originations.
High barriers to entry.
Exactly. Licensing, capital requirements, and it keeps newcomers out and protects profitability, allowing those 2.80% margins. Rocket gained 8% year-over-year in purchase share, hitting 27% in its segment, precisely as smaller players exited about 15% fewer competitors since 2022 hikes. Consolidation favors the leaders. While they compete fiercely on tech and speed, the market dynamics safeguard earnings, especially with Mr. Cooper's $200 million synergies coming.
And their sheer size must be a huge advantage, economies of scale.
Monumental. Originating $29 billion in Q2 lets them dilute fixed costs like tech infrastructure. That leads to the $172 million adjusted EBITDA of 15% YoY. Their cost per loan drops because AI automates 80% of processes, saving those 20,000 hours annually. This scale also supports the 97% retention and the $410 million quarterly servicing fees. Their origination costs are lower, 1.5% industry 2%, allowing competitive pricing like those 1% rate buydowns, which drives further share gains.
Does the platform benefit from network effects, more users making it better?
Yes, there are meaningful network effects. Those 65 million annual interactions create data loops that constantly refine their AI, leading to better personalized offers. Rocket Money managing $1.5 billion in subscriptions shows that engagement.
Redfin amplifies this.
Significantly, Redfin's 50 million visitors feed the ecosystem. More listings attract more buyers, who then convert to mortgages at a 15% higher rate. While mortgages aren't viral like social media, the user growth from the $351 billion originated in 2021 to 97% retention now shows how these effects compound. Plus, broker adoption 1,000 plus on enhanced splits amplifies reach indirectly. Scale begets value.
What about counter-positioning? How do they differ from traditional players?
Rocket's uniquely positioned as pure-play digital. Competitors like Wells Fargo can't easily replicate it because of their legacy branches and systems. Rocket focuses on AI-driven speed minutes versus days. Integrations like Redfin create that one-stop shop with perks like preferred pricing. The market clearly prefers it. 22 JD Power wins, 8% purchase share growth confirm that.
Are customers locked in? What about switching costs?
Switching costs are high in mortgages. There's the emotional tie to a home loan, often held 27 years. Financially, refi fees can be 5% of the loan amount, a real deterrent, plus the hassle of re-underwriting. Rocket's 97% retention, way above the 85% industry average, shows this stickiness. Ecosystem perks like Rocket Money add another layer, integrating finances.
How important is their brand in all this?
Very important. Rocket is a trusted, recognized brand, allowing premium pricing. Being the #1 lender isn't just volume, it's built on consistent digital excellence, fostering loyalty, that 97% retention, and pricing power, the 2.80% margins. The Help Everyone Home mission also creates an emotional connection, differentiating them.
Do they have any unique cornered resources?
Yes. The proprietary data, 10 petabytes, and AI patents powering Rocket Logic are key examples. These are assets competitors can't easily copy. Strategic partnerships like the PGA Tour sponsorships boost visibility and talent attraction. And their Detroit Innovation Hub helps attract talent, with 15,000 employees driving 20% efficiency gains.
And their internal processes themselves are an advantage.
Definitely. Those refined processes, especially AI automation and origination, create significant cost advantages, 20,000 hours saved quarterly. This enables faster closings and higher margins compared to competitors using older manual methods. It's a core differentiator.
Is the underlying technology truly proprietary?
Yes. Their AI, especially the agentic tools processing 80% of tasks, is described as 10x more efficient than legacy systems. This proprietary tech gives them a clear edge and positions them for continued dominance.
Did timing play a role in their success?
Impeccable timing. Launching Rocket Mortgage in 2015 perfectly caught the wave of digital transformation. With 85% of home searches starting online, they were positioned to capture 27% of online originations, establishing a strong first-mover advantage.
And their speed in adapting.
Remarkable agility. The Redfin integration lifted conversions 15% quickly in Q2 25. Their rapid AI deployments consistently outpaced competitors, discouraging rivalry and solidifying their lead.
Any other specific industry advantages?
Yes. The MSR portfolio itself, $6.2 billion value, generates recurring fees, acting as a buffer against cycles. That's a significant industry-specific moat. And post Mr. Cooper, servicing 1 in 6 loans, creates unmatched scale, leverage, and efficiency few can rival.
With such a strong moat, let's look ahead. What are Rocket's growth prospects?
They have a very clear, multi-pronged growth strategy. It focuses on market penetration, boosting loan share via digital tools, market development expanding into areas like real estate via Redfin, and product development continuous AI enhancements like Rocket Logic.
Can you give examples of each?
Sure. Penetration. AI automating 80% of processes boosted purchase volume 7% EOI to $21.06. Development. The Mr. Cooper deal enters a larger servicing market, adding $200 in synergies. Product. New broker portals cut outreach 20%, driving adoption.
What are the biggest growth opportunities?
Expanding nationally via Redfin's brokerage, introducing new products like better broker compensation splits, and M&A like Mr. Cooper, closing Q4 25, bringing that servicing portfolio to $1.2 trillion. There are integration risks, yes, but the reward is potentially that 10x business growth via AI. Their Truebill Rocket Money acquisition already proved they can diversify effectively, aiming for 20% non-mortgage revenue by 2025.
How broadly applicable are their services?
Very broad. Mortgage for consumers, brokerage for real estate. It applies high scalability. They handle 65 million interactions annually across diverse demographics. It's not a niche play. It addresses a fundamental need.
What is the total size of the market they're playing in, the TAM?
It's immense. The total addressable market is the $13 trillion U.S. housing debt market, with about $2.4 trillion in annual originations.
Can you break that down?
Roughly $1.5 trillion is purchase mortgages. Rocket has about 4% share there now, targeting 8% by 2027. About $900 billion is refinances, where they hold 12% and are aiming for 20%. The overall market is projected to grow at a 12% CAGR, or CAGR, hitting $20 trillion by 2030. Rocket, with its acquisitions and digital lead, is well-positioned to capture maybe 15% of that total expanding market.
So boiling it all down, what are the absolute key drivers fueling Rocket's future growth?
There are several powerful ones. 1, AI automation driving efficiency and throughput. 2, strategic acquisitions like Redfin and Mr. Cooper creating synergies and expanding reach. 3, the potential for lower interest rates striking a major refinance boom, maybe a 30% surge. 4, the proven ability to expand purchase market share, up 8% YoY even in tough times. And 5, the stable recurring revenue from their growing servicing portfolio, already 27% of their total revenue.
It's a compelling growth story, but every company faces risks. How resilient is Rocket when navigating challenges and broader economic factors?
Their supply chain is inherently resilient because it's digital infrastructure and partnerships, not physical goods. Minimal regional reliance, U.S.-focused, diversified brokers. AI hedges against labor shortages. Their customer base is also very broad, all demographics, accessed digitally across geographies. And that 27% focus on purchases provides crucial diversification away from pure refi plays, stabilizing revenue.
What about the risk of those strong competitive advantages fading over time?
It's a valid consideration. Rapid tech leaps by nimble fintechs or rates normalizing could invite more competition. But Rocket's acquisitions are specifically designed to strengthen the moat. The counter risk is integration failure. If they stumble integrating these huge deals, it could weaken them.
Does Rocket show signs of being anti-fragile, actually getting stronger from chaos?
Yes, strongly. The high rates recently weeded out weaker competitors, allowing Rocket to grow share 8%. Their AI adaptations turn stress into efficiency gains, like the 20% cost cuts. Converting adversity into advantage is a hallmark of anti-fragility. They don't just endure shocks, they emerge stronger.
What about their staying power? Is this a business built for the truly long term?
Their longevity seems tied to powerful secular trends. The ongoing digitalization of mortgages, 85% of searches start online. Key demographic shifts, millennials entering prime home buying years. Their AI investments position them for an AI-driven housing future, and fundamentally, homeownership endures. Rocket survived 2008 and posted 27% CAGR afterwards. Plus, $9.1 billion in liquidity provides a massive cushion against downturns.
What are the main risks to this growth story?
Primarily, potential market saturation in originations as digital adoption matures, and intense competition, especially from rivals like UWM focusing heavily on the wholesale channel. These are known pressures they actively manage.
How do we think about the different kinds of risks, the known unknowns versus the truly unpredictable?
Good distinction. Known unknowns for Rocket include interest rate volatility impacting MSRs and the integration risks of these large acquisitions. We know these exist, the outcomes are just uncertain. Unknown unknowns are the truly unpredictable things: major, unforeseen AI regulatory shifts, or significant geopolitical events that unexpectedly ripple through the housing market, things you can't really plan for.
Let's zoom out to the macro picture. How do factors like interest rates, trade, and inflation hit Rocket?
Interest rates are the big one. Lower rates expected from the Fed, maybe starting September 2025, cut borrowing costs, boosting refis. Rocket's $578 billion portfolio could see that 30% surge. Conversely, high rates squeeze them, leading to a Q1 25 loss. It's a direct link.
What about trade?
Minimal direct impact. They're U.S.-focused, avoiding tariffs. Indirectly, trade tensions could fuel inflation, affecting rates, but it's subtle. Inflation itself is more direct. It raises operating costs, up 5% YoY for Rocket, and can dampen housing demand. Rocket fights this with AI efficiencies and cost cuts.
Are there macro factors specific to Rocket or the housing industry?
Yes. The housing affordability crisis is huge. High prices deter buyers. Rocket tries to counter this with things like their preferred pricing program. Another factor is potential regulatory scrutiny on MSRs. Changes there could impact profitability or cap growth in that key segment.
Okay, let's get to the numbers. How healthy are Rocket's current financials? What story do they tell?
As of Q2 2025, the financials show impressive resilience in a tough rate environment. Revenue was $1.34 billion, up 3% YoY. Not huge growth, but driven by a solid 7% rise in originations to $29 billion. It shows them turning headwinds into share gains.
And profitability.
Net margin was 2.5%, so $34 million net income. Adjusted EBITDA margin was a healthier 13%, hitting $172 million. Margins are squeezed by rates, but bolstered by those 20% AI-driven cost cuts. Shows efficiency.
What about the Rule of 40?
Combining 3% growth and 13% EBITDA margin gives 16%. Below the 40% benchmark for hypergrowth tech, but for a mature company in a cyclical industry, it shows discipline and holds promise with acquisitions factored in. ROIC, return on invested capital, is respectable at 5.2%, showing efficient use of capital like with the Redfin bet.
How's their balance sheet? Cash and debt?
Very strong. Current ratio of 22x, debt to equity at 1.2x, plus $2 billion in undrawn credit lines. That's a fortress of flexibility. Free cash flow grew 10% YoY to $150 million, funding M&A internally.
And industry-specific metrics?
Origination volume, $29 billion, up 18%. Servicing portfolio, $578 billion, 27% of revenue. Gain on sale, 2.80%, all strong signs. In an oligopoly where scale wins, these metrics show Rocket's performing very well amidst consolidation.
How does Rocket compare financially to its peers?
They generally outperform. Revenue growth of 3% versus UWM's flat performance. 13% adjusted EBITDA margin beats LendingTree's 8%. ROIC of 5.2% is above the industry's 4%. Their digital edge yields that much higher, 97% retention versus 85% average. The trade-off is higher debt from acquisitions compared to more conservative peers.
What are the longer-term trends over the past few years?
Revenue dipped in 2023, high rates, but has rebounded, showing a 15% CAGR, or CAGR. Margins stabilized thanks to AI. Free cash flow grew 20% annually, the implication. They are really well positioned for a rate cut boom, potentially that 30% refi surge.
What's the absolute latest news? And crucially, how are individual investors feeling about Rocket right now?
Recent news is positive. Strong Q2 earnings beat, $1.34B revenue, Cibrivore EPS. Redfin deal closed July 25, synergies starting. Mr. Cooper deal on track for Q4. Externally, those likely Fed rate cuts starting September 25 are the big potential catalyst.
What should investors watch for next?
Q3 earnings in October are key. Look for integration updates on the acquisitions and any Fed decisions. Also, that high short interest, 32% of the float, 5.4 days to cover, is something many are watching closely. Potential for a squeeze if good news hits.
And the sentiment on places like X, formerly Twitter?
Generally bullish among individual investors. Focuses on acquisitions and rate cuts as catalysts, the Coiled Spring idea. Concerns center on that short interest, squeeze risk versus dilution fears from debt. But positive views often highlight a Redfin synergies, calling it the Amazon of housing. Optimism about the 30% refi surge is common. Overall, filtering out noise, sentiment seems about 70% positive.
This brings us to the bottom line, the verdict on Rocket's valuation and the core investment thesis for you.
Valuing Rocket needs multiple angles, intrinsic, relative, advanced methods, given its fintech mortgage hybrid nature.
Let's start with intrinsic value, discounted cash flow.
Right. We model future free cash flow, Q2 25, $150, up 10% YoY. Discount that back using a WACC, weighted average cost of capital, maybe 8-10% for Rocket's risk profile. Assume a 12% revenue CAGR to $6 5 beats by 2030, driven by acquisitions, rate cuts, and a terminal value at 15x FCF. This approach suggests an intrinsic value around $22 to $25 per share. That feels robust, especially factoring in Mr. Cooper's $200 EBITDA synergy potential.
How does it look compared to peers' relative valuation?
Its trailing PE is high, around 45x versus peers near 20x, but forward PE could be 30x if EPS hits analyst estimates of $1.60. Its enterprise value EBIT is 18x versus UWM's 12x, reflecting a premium for Rocket scale and integrated model.
And advanced methods like sum of parts.
That values the segment separately. Origination may be $10 EV, 10x EBITDA, servicing $50 up for the 578B portfolio, 2.6x book. Crucially, remember MSR sensitivity. A 50 basis point rate drop could add $500 value to servicing.
Which brings us to margin of safety. How important is that here?
Crucial for any investor. It means buying below that calculated intrinsic value, $22, $25, maybe aiming for $15, $17 entry to build in a 20-30% buffer against volatility or errors, like rates not falling as expected. Valuation tells you if it's undervalued, buy, fair, hold, or overvalued, sell. It guides decisions and helps spot that coiled spring potential. DCF works well for Rocket's AI synergies. Relative valuation helps benchmark.
Okay, let's steelman the arguments. What's the bear case?
Institutional bears point to high debt, 20 post-acquisitions, risk of default if rates stay high, eroding margins, 2.5% net 2023 loss. Also dilution from stock deals like Mr. Cooper, hurting EPS. Retail bears on social media often focus on the high short interest signaling overvaluation, maybe AI hype is unproven, rates not falling fast enough for a refi boom, leaving revenue stagnant versus 2021 peaks.
And the bull case.
Institutional bulls see acquisitions creating $200 richies, positioning Rocket as the housing Amazon capturing 15% TAM. They stress AI saving 20,000 hours, enabling 10x growth. Retail bulls see the high short interest as a squeeze trap, 5.4 days to cover, rate cuts sub 25, sparking that 30% refi surge. The Echo views calling Rocket a juggernaut.
So weighing both sides, what's the most probable outcome?
Leaning strongly towards the bull case feels more probable right now. The Q2 earnings beat and that $9.01 liquidity support the upside potential. Therefore, at its current price around $18, Rocket trades at roughly a 20% discount to that $22–25 intrinsic value range. This aligns with the bull thesis. It looks coiled, primed for gains from rate shifts and successful integrations.
So circling back to our central question today, the answer seems to be a clear yes. Rocket Company's stock looks very much like a coiled spring, primed for potentially significant growth.
That's the assessment. Absolutely. It appears positioned to deliver. Those strategic Redfin and Mr. Cooper acquisitions are forging a truly vertically integrated powerhouse, servicing 1 in 6 U.S. mortgages, expanding the purchase funnel with Redfin's 50 million visitors. We're seeing early synergy wins like that 15% conversion lift, and the $200 million target by 2027 is substantial.
And the AI factor is critical here.
Critical. Rocket Logic automating 80% of processes, saving 20,000 hours quarterly that positions them perfectly to capture a potential 30% refinance surge if the Fed cuts rates as expected in September. This isn't just theory. Q2 results showed resilience, $1.34B revenue up 3% YoY, 8% purchase share growth, all backed by $9.01 liquidity. In this oligopoly, their scale and tech mode could turn macro tailwinds into really asymmetric upside.
From a first principle standpoint, why is housing such a durable foundation for a company like Rocket?
Because fundamentally, housing remains a bedrock asset class. Rocket's digital dominance just makes accessing it more efficient, tapping into that enduring demand. Unlike volatile sectors, mortgages, especially with servicing, offer compounding through cycles. That servicing income is like a recurring annuity.
Are there informational edges for investors here?
Potentially. That high 32% short interest creates a squeeze possibility if rates drop. Watching MSR values, $6 and 2Bs closely, can be a leading indicator slowing prepayment signal refi booms early. And the unpriced potential of AI, that 10x growth goal without adding headcount, might be undervalued in standard DCF models projecting maybe 12% CAGR.
So execution remains key, but the market structure helps.
Precisely. It hinges on execution. But the fundamentals are supportive. Redfin is integrating, feeding the pipeline. Lower rates, projected 5.9% in 25, unlock value in that huge servicing portfolio. And the oligopoly dynamics favor leaders like Rocket, 9.2% share. Barriers crush smaller players. Remember their post-2008 rebound, 27% CAGR? That's proof of anti-fragility.
You mentioned an interesting analogy earlier.
Yes, some have drawn an interesting parallel, noting that Bitcoin's long-term bull case sometimes mirrors housing's role as a scarce, appreciating asset, especially in inflationary times. From this perspective, Rocket's fintech approach to housing could be seen as reflecting that disruptive potential seen elsewhere, modernizing a traditional asset class. It's just a perspective some hold.
A thought-provoking comparison. So for you, the individual investor listening, what's the final actionable insight? That edge truth?
To wrap it up, Rocket looks coiled, ready, but approach with discipline. Buying with a margin of safety, maybe aiming below $17, provides a buffer against volatility, even as acquisitions and rates act as catalysts. And here's a final edge insight. Keep a close eye on broker adoption via Rocket Pro. Seeing 1,000-plus partners adopt those enhanced splits in Q2 is an under-the-radar sign of wholesale growth potential that could add another 20% revenue lift. Nuanced data points like that, often missed by the market, can give you a real advantage.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.